What's next for markets?
I'm Michael Kantrowitz, Chief Investment Strategist at Piper Sandler, where I lead the portfolio strategy team ranked #1 on Wall Street in the All-America Institutional Investor Research Survey. Well, good morning, Jackson, and good morning, Stephen. I'm pretty lucky today because I think I am joined by two of the smarter people on Wall Street that are most informed and understand indices and index rebalances and index earnings and how we really calculate all this data the correct way, because there's plenty of, I think, people doing a lot of back of the envelope math there. So Jackson, welcome. Excited that you joined us on the podcast. Jackson is the head of index rebalancing at Piper Sandler. And so Jackson, I'm curious, what does that mean? What do you do day to day? What are your conversations about with clients?
Thanks, Stephen and Cancho, for having me. Nice to be with you. I've been with Piper 6 years, lead Piper's index rebalance platform. And essentially what that means is predicting index events that are going to happen in the future, both for the major quarterly rebalances, which generally take place in March, June, September, December, and everything that happens in between. So whether that's corporate actions or a deal is closing and it's going to open up a spot in the S&P 500, predicting which company is going to be added to the S&P 500 to replace it, among a number of other things. So the clients that I speak with are the largest indexers who are managing the passive index ETFs and mutual funds. So the passive index community. 2 would be hedge funds that pre-position for these events and provide liquidity. Obviously, if a company is being added to the S&P 500, means that there's going to be a lot of stock that needs to be bought on the rebalance day. And so where does that liquidity come from? There's hedge funds that pre-position for it. And so our trading desk helps facilitate these index rebalance events. I think over the last couple of years, we've seen long onlys and fundamental hedge funds equally as important to them, just because the passive part of the market has now either approached or exceeded 50% of US assets. And so we've seen a lot of hedge funds starting some of their investment thesis and universes by looking at, okay, which companies are potentially going to go into what indexes before they even start some of their fundamental work, just because they know that if they can get ahead of some of these flows, it can be really meaningful from a catalyst standpoint. And then long onlys, obviously, if they know that this company could potentially get added to one of their benchmarks in 3 months or 6 months, how should they think about timing in terms of when they should be buying various stocks? So that's what I focus on. I also work super closely with capital markets and banking because obviously CFO teams and CEOs, if passive assets are half of the US equity market, it's a huge portion of the equity side of their capital structure. So spend a lot of time working with CFOs and management teams to understand how they can position themselves to get included in all the right indexes and then take advantage of the liquidity events. I think where we stand right now is there's a lot going on in the index rebalance space, probably more than I've ever seen in the last 6 years of doing this. Right now, we're in the middle of a very large rebalance cycle, the largest of all time. And what that means is essentially across MSCI, S&P, NASDAQ, Russell, and a number of other index families, there's going to be roughly $600 billion turnover over the next month. And then in addition to that, you've got the SpaceX IPO, which a number of the major indexes have actually changed their methodology to make sure they can get included in those indexes on a fast track basis. So rather than waiting till the next quarterly rebalance to add SpaceX to the indexes, they've changed the methodology so that can be accomplished in the first 2 weeks. And so it's gonna be a completely different trading profile and dynamic for many of these IPOs, SpaceX and then Anthropic and OpenAI later in the year.
So I started my career in research at Merrill Lynch in the small cap team, and I used to work on a project to predict the Russell rebalance. This is back in 2003, 4, and 5, when there weren't as many rules as there are today, and there wasn't as much visibility as there is today. And I guess one of the things that surprises me is 23 years later, that investors or traders can still arbitrage this. So is it happening earlier and earlier as people are well aware of these potential index additions and deletions, and how much earlier do you have to get ahead of these things?
Yeah, Russell has gone through a number of phases. This year is going to be the largest Russell reconstitution of all time, with roughly $300 billion in total turnover that the index community needs to trade. And so that's the big three type indexers plus pension funds and sovereign wealths and folks benchmarked will have to reshuffle around that time too. So that's in excess of $300 billion. And if you look at the last 3 or 4, 5 years, usually it's somewhere between 100 and 150 billion in turnover. So this rebalance is so much bigger than it has been historically. And I think part of that is because of just assets that have flooded into Russell funds, and the Russell is up 20% in the last year. This year will be the most Russell 2 to Russell 1000 migrations. I think it's 8 or 39. Usually it's more like 15 to 20. And a lot of that's like your Bloom Energies, and a lot of AI names are driving that. So I think in terms of the size of the rebalance, that's how I'm thinking about it. In terms of how these are gamed or pre-positioned for or facilitated, when the rebalances historically have been a lot smaller, the market has had plenty of capital to pre-position for them. And so there's so many eyes on these predictions that I think like it was a much more saturated trade. And you'd see a lot of the companies being added actually go wrong way and sell off into the event. And a lot of the companies that were being removed actually rally just because the trade got so saturated and everyone got in the trade. That this year, like we haven't necessarily seen that. Like MSCI was actually really strong into the close of last Friday, which is when MSCI rebalanced, and all of the buys performed really well and all rallied into the close and all the sells sold off. And so I think like the reason that we've seen that, and I probably expect that to continue, is just the size of this cycle is so big that a lot of the liquidity providers and hedge funds that are involved in the strategy are just spread thin. There's just only so much capital and $600 billion to pre-position for. So that's our view on how performance has been and how these have traded. I think the final thing I'd be thinking about is probably 5-6 years ago when I started predicting Russell changes, it was a lot of work in Excel and a little bit of Python. And then in the past 2 or 3 years, it's gone largely to Python and code. And this year, most of our model is done with AI. And whether it's like domicile related issues, like figuring out, is this company a US company or not? And is it eligible in Russell for that point of view?
Sure.
Like being able to scrape through filings with AI and come to those conclusions for whether or not a company is eligible. Like AI is making it so much more efficient that I think this year our prediction was like 99% correct. So like people can predict these things like starting in January, February. And I think the markets is so much more efficient from that standpoint.
What are the differences between S&P and Russell, and what are the rules?
For sure. So you've got broad market indices, and then you've got more narrow type of frameworks. And so when I think broad-based, I think of S&P total market. I think of CRISP, which a lot of people aren't necessarily familiar with the CRISP index family, and that's broad-based across pretty much all U.S. names. Russell, both the 1000 and the 2000, which make up the Russell 3000, is a broad market family. Same thing with MSCI, which MSCI has a global focus, but it's broad-based. And then you've got NASDAQ 100, which you have to be obviously traded on NASDAQ, and the 100 largest companies that are NASDAQ listed and not financials. And then the S&P 500 is the 500 largest companies in the U.S. stock market that are U.S. companies. So you have like the broad-based set, and then you've got NASDAQ 100 and S&P 500, which are a little bit more narrow and focus on either tech or just large cap specifically. And so I think you've got some indexes that are rules-based and very mechanical, and then you've got S&P 500, which is committee-based. And where Russell, it's very easy to predict which companies are going in and out because we got the rules and you just can build a script for it. S&P does have its rules, but this Friday after close is when they're going to choose which company's going in the S&P 500, and that's around a dozen people on a committee that sit around and have some discretion on which companies are going in and out. I think that there's certainly pros and cons to both, but in terms of the methodology changes that these indexes have considered, particularly with respect to SpaceX and Anthropic and OpenAI, the big problem has been historically companies that have a low float. So typically that's below 10% or below 5% are not eligible for indexes. There's a number of reasons why they haven't included them historically, but now we've been presented essentially with 3 large IPOs, all of which will likely be under 10%, if not under 5%, certainly to start until their lockups come off. to start for SpaceX with a $75 billion offering, assuming a valuation of 1.75 trillion. That floats 4.3%. So SpaceX, under the methodology for Russell and S&P total market and a number of other indexes, would never see inclusion until the lockup comes off. And so I think the problem has been a lot of the retail holders who own these index funds want exposure to it right out of the gates. Or maybe if you don't include these, then it's not representing the US market effectively. And so that's why they've thought about essentially changing the rules to make sure that they can get added within the first 2 weeks. And so essentially what the methodology changes they've proposed and passed in the last month is if you're a mega cap company only, so you got to be typically over $125 billion total market cap company, then we're going to waive the float requirements and allow for immediate inclusion within the first 2 weeks. S&P 500 is a little bit different. They've said that you have to season and trade for 1 year. And in addition to that, you also have to be profitable. So essentially what this means is most of the indexes are going to add them in the first 2 weeks, and S&P 500 will not be added for 12 months. So this is just a completely different dynamic from anything that we've seen in the past for any of these IPOs. And it's going to lead to roughly $18 to $20 billion worth of SpaceX demand in the first 2 weeks. Most of these indexes will weight SpaceX based on the $75 billion float market cap to start. So these indexes weight based on the float market cap. As SpaceX stock comes unlocked, the float will increase, and then at subsequent rebalances, there'll be upweights and additional demand as we go.
Yeah.
So in total, over the next year and a half for SpaceX, we're going to see around $20 billion in the first 2 weeks, and then another $290 to $300 billion of SpaceX demand over the next year and a half. So it's going to be super impactful.
So what will the float be at that point as a percent?
It'll be roughly 40%.
Okay. So it's still going to be a big weight in the index, but is going to weight the stock based on that float percentage. So that will, once it gets included, and if there's more lockups released, it'll continue to expand, assuming the price doesn't change.
Let's talk about that one a little bit, because there's so much news about what's SpaceX going to be priced at and what the market cap is going to be. And I've seen numbers like 1.7, 1.8 trillion. So right out of the gate, for an index that is float adjusted, it's not going to be adding 1.7 trillion in the actual weight of the index. It's going to be this float adjusted number that you're saying is going to start at approximately what percent before we get to that 40% you just mentioned?
Yeah, the weight initially, it'll probably be most of the broad-based indices around 15 bips, so 0.15%. And then once all the stock comes off, it'll be more like 2%. It'll look like they'll have a weight similar to AMD.
Yep.
But it's going to certainly take some time.
And I think that's an interesting nuance that people don't always get. You can't just take the market cap of companies, add them up, and then divide. And you're saying SpaceX and some of these IPOs are so closely held that a lot of that float is going to roll on. So that it's going to be like a constant roll up in terms of their weight in the index as we go.
Exactly right. And so typically how IPOs work is the lockup's on the 180th day. So all the stock that was from pre-IPO holders and locked up comes unlocked on day 180. That's for the majority of IPOs, that's how it works. The problem is if all the stock, which would be about $770 billion worth of SpaceX stock, comes unlocked all in one day at day 180, first, it's going to be a ridiculous amount of supply. And a lot of times how lockups are facilitated is hedge funds will short stock ahead of time and then cover into the supply to provide that liquidity. So if you've got $770 billion of stock coming unlocked all in one day, the market can't pre-position short and get short enough stock to facilitate that and cover that into those blocks. So I think that's one part of it. The other part of it is if all the stock comes unlocked all at one time, then now all of the indexes need to increase their weights at the same time. And there's going to be so much demand for SpaceX that the rebalances are going to be so big that the market can't facilitate those sort of events either. And so essentially, the indexes and SpaceX has done two things to try to make it easier for the market to facilitate those. And one is SpaceX has decided to stagger their lockup. So It'll be around 30% of that lockup comes on August earnings. There'll be a number of 7% unlocks on day 70, 90, 100, 120, and 135. Another big slug in Q3 earnings, and then the rest on day 180. So they're essentially spreading it out. That way the market can digest it, and then all the rebalances can be facilitated thereafter. So I think that's something that's super different from that SpaceX has just based on its size that we haven't really seen historically. One thing,
Jackson, a question I'm sure you've been getting, who's going to pay for it all? In other words, where are the fund flows going to come from to finance the passive bid increases and the active managers and retail investors that want a piece of the SpaceX IPO at some point or on the first day of trading? What are they going to sell? Where is it going to come from? That seems to be the concern in general for other stocks, and maybe within the tech space in and of itself. Will this be a big cannibalization event?
Yeah.
And who's going to get cannibalized?
Certainly one of the most frequently asked questions. And on the program trading desk, we call it the funding trade. So if a company's being added to an index, then there needs to be a funding sale of all the other constituents in the index. And that goes for both the passive, the strictly tracking the index funds, as well as the long onlys who are benchmarked to it. I think in the short term, in the first 2 weeks of SpaceX trading, there's going to be $20 billion of SpaceX to buy for across those indexes, which means that there's going to be $20 billion for sale across those remaining constituents of that index, which I think about in a couple ways. One is the Mag 7 is so liquid that $20 billion across those 7 names is pretty much nothing. And two, in 2019, 2021, Tesla was added to the S&P 500. The float market cap wasn't $75 billion, which is what SpaceX is going to start with. It was over $1 trillion. And so the demand for the Tesla S&P 500 ad was like $120 billion versus this is only $20 billion to start. So it was much more significant trade for the Tesla S&P 500 ad. And during that period, like the rest of the other 499 constituents of the S&P 500, like barely budged at all. So I'm not concerned about the funding trade in the short term, and probably especially not in the long run, just because it's spread out over such a long period of time with the lockup structure. But it's nonetheless like one of the most asked questions around SpaceX IPO.
Yeah, well, considering everything you brought up and how big of an impact things would be if they had not made these adjustments to essentially spread out the impact, it does seem like a reasonable thing to do given the size of the company. So when you speak to clients about that and they understand and realize that, oh, the impact, that's not like we have to buy $1.8 trillion of SpaceX on day one, do they just walk away and say, okay, I don't have to worry about it?
Pretty much every single one, yeah. Our markets are so deep at this point for the top 50 names in terms of market cap that you can get significant notional amounts done with very limited market impact.
Interesting. It's always good to provide some clarity into a question, because I've certainly heard people talk about that on CNBC and Bloomberg, and I don't want to name any one channel, but broadly. So it's certainly conventional wisdom out there. So that's, and a lot of people were also talking about, look what happened in 99 while the lockups opened up. But again, I imagine those were not staggered back then.
Right. I think the final thing to wrap up on SpaceX and how various market participants are thinking about it would be the big indexers are trying to figure out how much stock they want to get on the actual deal versus waiting until day 5, day 10, day 15 when the index tells them to buy. I think a lot of the hedge fund liquidity providers that need to be there providing that liquidity on the index events are figuring out also how much do they want to get on the deal versus buy in the market on day 3, day 4, day 5 leading up to that event. And then I think the hedge fund community, like there's a lot of eyes on this deal for sure. I think the big focus is lockups and getting short ahead of the lockups and then getting long coming out of them, knowing that there's so much index demand that's going to be coming off the back into year end and then early 2027. And then I think finally, like on the long only side, like the big long onlys, like they know it's going to be like a meaningful portion of their benchmark at some point. It's going to start out as a small weight to begin with, but it'll get to 2.5% at some point. And so then it's thinking about timing. When should I be buying SpaceX, after or on the day of when it gets added to my benchmark? So that's how various folks are thinking about it.
Do we know which GIC sector that's going to be included in?
That's another interesting point. Comm services or tech or industrials on the rocket side. So yeah, we haven't heard back. Probably right around the IPO time is when we'll hear from GICS on that.
Well, that's another good example of why these 11 sector definitions nowadays are just not so useful, and if anything, sometimes provide some misinformation or misunderstanding of where a stock should be. This was really interesting. Excited to see this play out in the next several weeks, and I'd love to have you back on maybe a little later this year as another big IPO gets on the docket.
Thank you.
If you like the show, please let us know by leaving a positive review. The preceding commentary is not financial advice. You should always seek appropriate financial advice from a professional financial advisor in your state. You should not consider this as a substitute for these services. Piper Sandler does and seeks to do business with companies covered in its research commentary or coverage. As a result, investors should be aware that the firm may have a conflict of interest that could affect the objectivity of this commentary. Investors should consider this commentary as only a single factor in making their investment decisions. For full disclosure information, visit www.pipersandler.com/researchdisclosures.